We are live. Thank you for joining us. Let me know, folks, if you think that the 5-minute intro is too long. Had the marketing team put together a 2-minute and a 5-minute. I just like a little bit of buffer, a little bit of time for it to go live, people to see that we're live and join in. I see that we've already got people in the chat letting us know that you're here, you're ready to get engaged, you're ready to ask some good questions. If you didn't join last week, you can always go back and look at the past episodes. We had a senior underwriter on last week from United Wholesale Mortgage. It was a great episode because I try to answer mortgage questions the best I can. Brett was able to really get into the weeds, and I learned a bunch of stuff. One note, as I was looking over last week's note, that I thought was cool, the system that recognizes appraisal waivers on a cash out on a primary. If you're at 71%, you'll never get an appraisal waiver. You lower that to 70% and you start seeing appraisal waivers. So let me know if my sound is good. I got a new mic that's hanging down from up top right here. And so I don't know if the sound is dialed in quite yet, if I got to adjust that, turn it up or down, or change it from the heart mode to something different. But we'll jump right into it because I think that's the best part of this is going, back and forth. Great questions every single week. Some familiar faces like Kevin. Thanks for joining, my man. Appreciate you. Tanner, I saw this one. This stuff always brings a smile to my face. So I appreciate anybody sharing any part of their story with us. Been in contract for almost a year. It's going to be done in 2 to 3 weeks. Congratulations. It's awesome to know that in some way we've provided some sort of help, right, to you, making it maybe less stressful when you had questions at times that you may not have got the answers from the builder's lender. Good to hear that we played a small part in it. So congrats again, man. Come back and let us know once it funds and record and it's all done. Jason, thanks for joining. Glad you were early. Yeah, sometimes even the best intentions, right? You're like never able to jump on when it starts, but here you are. You done it. There you go, Theo. I was going to tell you to start skipping class, man, to join the live, but good to hear that maybe you have a break this week from school so you can join us. This is a good question, and we'll answer this one. How soon after escrow is opened can you ask to lock your rate? Well, this is a common question where people are often trying to tell me, hey, listen, I want to lock my rate before we get into escrow, right? They're like, hey, I want to apply, get a loan approval, lock my rate, and then go find a house. It doesn't work that way. There's some products out there, but it's more smoke and mirrors than it is true products. So don't even worry about it. Once you have a fully executed contract, general practice for us, especially in a rising rate environment like we're in right now, receive the contract, contact title to get the title fees, disclose to you with those accurate title fees, and lock the rate literally within 24 hours of getting into contract. So that's the time frame you can expect for that. Immediately after disclosures go out, we've got some verbiage on our email that says, sign these, let us know if there's questions. But once we have those signed disclosures, that's when we're able to submit to the lender and order the appraisal. And so for your question here, what's the typical time frame for an appraisal and what happens after you pay for it? Let's say that you get into contract on Sunday, we get the title fees Monday morning. We disclose your initial loan disclosures, 80-page packet where you're signing, a few pages that are actually relevant in a loan estimate, 70 pages of legal mumbo jumbo. Let's say you get those Monday night. You sign those. My processor sees that they're signed, submits to the lender, orders the appraisal. You see that link Monday night. You go ahead and pay for your appraisal. Tuesday comes around. That appraisal is going to get assigned to an appraiser. And right now, and this is really like dependent from state to state, even from county to county. So what I tell you on what I'm seeing in Northern California, it might be different in Michigan. It might be different in Nevada. I know agents in Nevada that are waiting 30 days for an appraisal to come back. I would say if it was us here in Northern California, that thing gets assigned on a Tuesday. It probably gets scheduled and inspected within 5 to 7 days and then returned to the lender. You get a copy, we get a copy, 10, 12, 14 days, depending on, if it's a little bit rural, if it's, a type of property that appraisers see and say, no, thanks, that's a big scope of work, whatever it is. But, within 2 weeks from paying to actually seeing a copy of the report is probably a good timeline. But again, Oregon, it might be longer. Nevada might be longer. And I've got loans going on all over the country. It's literally different in every place. I don't know, Liberty Returns, where you're hearing about 40-year mortgages, but the only 40-year mortgages I'm hearing about are modifications from servicers to people who are exiting forbearance. I'm writing 0 40-year loans. Any mortgage broker I know writing 0 40-year loans. Basically, 40-year mortgages don't exist unless you're a servicer doing some sort of modification. So, I don't know, hashtag controlled market, conspiracy theory, all you want. 40-year mortgages are not a thing, but makes for a good headline, right? Jason Hibbert, can I refinance my primary residence into an investment property? If so, how soon do I have to move out? It's a multi. I would ask what your game plan is and why you would want to do that. If you're living in it, you're going to get much better terms as a primary residence. And then if plans change 6 months, 8 months, 10 months, 14 months down the road, you move out and buy something different as a primary. The only good reason for refinancing it as an investment, if it's like, I'm doing a cash out as an investment because I know I'm going to buy something next month with that cash. That's a good idea, because you try to do a cash out as a primary and then buy something new as a primary a month later, lender's going to say, no, not going to fly. And they will actually make you refinance the one that you're moving out of as an investment property. I've seen that and heard that more this year than ever before, where people are being kind of called out on any sort of like occupancy issues and saying, no, like we won't close this purchase forward until you refinance that thing as an investment property. All right. Sound is good. That's good to hear. We got about 18 inches between me and the, is that Blue Yeti, Mike? Dialed. Chris Kennedy, thanks for joining, man. Appreciate having you on. I talked to a few different people last week. I was on a few different podcasts where they asked me for my feedback, my guesstimates. It's fun to do because, like, what's the worst that can happen? I'm wrong. But I think that, between my just guesses and smart people I'm listening to, what I'm seeing with inventory, what I see on the future with interest rates, there's so many different variables that go into it where, you can take an educated guess, I think is what I think it is, for somebody like myself, who's all day, every day in housing, in mortgage, real estate, agent conversations with investors, conversations with other mortgage professionals. I feel like I at least have the advantage of some of that knowledge, where interest rates are headed, what current inventory levels look like, what the demographics are for who's going to be buying in the future, all that stuff, right? And with all that stuff to think about and to kind of put into a big basket and mix it up and say, what is 2022 going to bring? My honest answer is 6 to 8% price appreciation. As we've seen we've had some year-over-year numbers in some markets that are 22%, 18%, 16%. I don't recall offhand what the national average is, but like you've got people that are looking at like, August of 20 versus to August of 2021, and that's like your year-over-year average. So every month that's going to change when you're looking at year-over-year averages, but it's going to be in the teens as a nationwide average for 2021 as a whole. And then 2020 also had a big home price appreciation number from 2019. Will that huge number continue? I doubt it. And I certainly don't think that that is something that's, sustainable. And so it would be bad for housing to see another 15, 20% home price appreciation across a bunch of different markets. And so with interest rates inevitably going up, that will quell demand a little bit. With, somebody told me recently, or maybe I was listening to something this morning, like permits right now are higher than they've been since like the 1970s. Some crazy number, right? Some other things that will quell, but then inevitably you've got supply versus demand imbalance, where there's a lot of demand for a little bit of supply. You've got 34 to 36-year-old, the demographics that are buying the most housing, more and more of them are coming into the market, looking at age demographics. Who was born in 1988, 89, and 1990? Those numbers are bigger than the numbers from 86, 87, 85, right? And so more and more people age into those brackets where they're buying homes. That pushes demand up. And if the demand goes up and we're not keeping up with supply, which we haven't been, a decade plus of like not building enough housing, that's going to continue upward pressure on housing prices. So I think 6 to 8% is my conservative estimate. I don't want it to be 10% or higher. I've got, 100 plus people pre-approved and shopping in just California. And so as somebody who's on the buy side, like my loyalty lies with buyers. If you're a real estate agent, you've got some buyers, you've got some sellers. The sellers want the prices to go up 20% next year. I'm all buy side. All I do is work with buyers. So I want prices to, stay relatively flat. 4, 5, 6% would be something that's more in line with historical averages and something that it's going to allow more people to enter the housing market, right? So anyhow, a long-winded answer. That's my guess, and I'm sticking to it. The caveat that I've got to end with is that you're in Houston, Texas. Houston, Texas is going to be different than Sacramento, California. Sacramento, California is going to be different than Lubbock, Texas. And Lubbock, Texas is going to be different than Nashville, Tennessee. Atlanta, Georgia is going to be different. Everywhere, the real estate is local. And we can have a national average that's going up 17%. That means that some places in Idaho in 2021 might have seen 25%. San Diego, California, Phoenix, Arizona, some of these places saw huge 25% plus price appreciation jumps, where other places were flat, 0 or 4% or 6%, right? And there might even be places in the country next year that go down by 5%. A lot of people point to different areas that have seen crazy growth and say that's going to reverse itself, or at least, course correct a little bit, right? All right, end of that. Hopefully that was helpful. Jermaine Battles, great question. When will the official announcement be made about the conforming loan increase? FHFA every year comes out and says, here's the new conventional loan limits. If you've been paying attention, if you've been watching this channel, if you've been following other mortgage folks, you've seen we can now lend $625,000 across the board. We can now lend in California in the high balance counties up to $937,500. This is all in anticipation of higher loan limits without actually knowing them. So end of November, I think it's going to be next week. Next Tuesday, for some reason I have that in my head, next Tuesday, November 30th, FHFA is going to come out with new loan limits. I can tell you, I think it's going to be higher than 625 as the conforming loan limit. And for all the high balance counties like we have in California, where they're guesstimating 937, 500, I heard from somebody who's smart, 822,375 is the current limit. If you're in San Francisco, San Mateo, Los Angeles County, Orange County, San Diego, these big high balance counties in California, I heard that one might go up by 18%. If it does, that's like a $970,000 loan. That's not a jumbo loan in California. That's huge. I mean, you could buy something for $1,050,000, put 10% down, and have a conforming loan. That's cool stuff. Unfortunately, that's the reality in some of these high-priced counties in California. You know, for some people watching this in Ohio, it might seem crazy, but you know, might be a 2-bedroom, 1-bath in San Francisco County or in you know, San Diego by the beach. Zeta, appreciate you. Thank you so much for all the support, showing up for the lives, every single Facebook comment. I want you to know I appreciate the heck out of it. So happy Thanksgiving to you and your family as well. We are going to be in town, spending time with family as we should. Have never traveled on Thanksgiving. Thankfully, I got a bunch of family in town. And so, yeah, we'll be hanging out in Sacramento, spending time with friends and family, being thankful for lots of stuff, right? So thanks, Zita. I appreciate you. Happy Thanksgiving to you. All right, Marco Polo. Shout out to Kaylee on your team who's taking care of us. That's awesome, man. This is a good question. You want a list of fees? I don't offhand have. I'm going to take a quick picture of this so I can send some kudos to Kaylee. So excuse me while I take a picture. Smile for the camera. Where I've got different sheets. You know what? Let me try to look it up. So I think I might have it for. I got to find one where no one's name's on it, right? No information's on there. Loan estimate, YouTube. Yeah, see? I call it. I name it for YouTube so that I got this big old screen. So let's see. Oh, you know what? Genius idea. All right. I should be able to share this. Share that one. I don't know if you can see this on the screen, but this is an old one that I saved. I whited out the names. And I could literally scroll through here and show you so that you can see, like, this is a loan estimate from a lender. So if you want to know what type of fees go along with a residential refinance, I'm going to zoom in there so we can see it. It's a little bit choppy. I probably whited out some borrower information there. It should be good. Box A, this is the loan estimate. Let me start there. If no one's seen a loan estimate, this is always, 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 always what a lender's going to send you. It's the form that every lender's got to use, right? And so on page 1, loan amount, interest rate, principal and interest, escrow for your taxes and insurance, and it'll show, you know, here's $2,832 in loan costs and $3,621 in other costs. They lump it all in closing costs, even though, truth be told, like, those other costs are prepaid property tax and insurance. Those aren't necessarily costs. I'll get into that in a second. Then this estimated cash to close. people got to be careful with this, because there's either a from or a to borrower. And people will say $1,338, I'm not bringing that to close. And I go, look, it's check to borrower. You're getting that back at closing, honey boo-boo. Anyhow, let's go to page 2 of this loan estimate. This is where it breaks down every single fee. And if you talk to us about a refinance, we're going to show you this, on an Excel spreadsheet where it says A, origination charges, B, where it's got appraisal and whatnot, C, the title type stuff. And so we're going to show you every single one of these fees before you even get started. Once you get started and you submit it, box A is going to have points if there's any points. This one doesn't have any. Underwriting fee, which I used to do 1055. We no longer do that. We just eat that fee. If there's a processing fee, it would be in this box too. So any fees that come from the lender are box A. Anything outside of box A is not controlled by the lender. Appraisal fee is just what it is. Credit report and tax service and all this stuff. Box C has title fees. Those are going to be similar. Really, whatever title company you use, you should expect to pay $1,000, $1,100 in total title fees. And then go up to box E here. This $385 is a fee that it supports. What is it called? It's something that got passed like 2 years ago, and it's for affordable housing, like fund. So you're paying to a good cause, but that's $385. Then you've got your prepaids and your initial escrow payments in F and G. These, like I said earlier, show up as quote unquote closing costs, and they get put into this total. But truth be told, like these 6 months of homeowners insurance that you're paying into your escrow account, and these 7 months of property taxes that you're paying in your escrow accounts, that has to be paid regardless. It's not coming to the lender. It's not like going out into, the abyss. It's being paid to the to the county for taxes or the insurance company for insurance. Whether you pay it here, whether the old mortgage pays it, whether you pay it directly out of pocket, it gets paid, right? It's just a prepaid cost. It's not something that's specific to this transaction. Hopefully that made sense. So really, like when you look at a refinance, I tell people to look at box D. That's the total of the true loan costs, right? $2,800. And if you're looking at this and, let's say we're refinancing this person and their payment used to be $1,720 a month, and we're going to $1,420 because we're lowering their rate to 2.831. They're saving $300 a month. If it costs them $2,800 in loan costs, less than 10 months, they're recouping that cost. It's a deal that makes sense if they're going to stay in this home, right? And so that's the list of fees right there. And if you're working with us, you're going to see that listed out for sure. So hopefully that helped. How do I stop sharing? Asking you guys. I did it. All right. Nailed it. Plan to cash out for a second. I'm concerned about having 2 primaries. Will I have to move out right away? You don't have to move out right away, but I would, what I would probably do? I talked to a lender, and I wonder if you could do this, both of them at the same time. That way you're collecting all the docs at once, right? You're not supplying all this loan documentation to get this loan closed, and then next month or the month after having to get all those updated docs. That's a good question, because that's happening a lot more right now. People have a ton of equity. They want to take some of this equity and buy the next place, but they want to keep this house because they understand controlling real estate builds your wealth long term. That's a great conversation for another video, but a rental property is worse terms for you. So I would imagine the lender's like, sure, you want to pay 3.625 instead of the 299 you're in, let's do it. I don't think they would, necessarily be on you about moving out right away. I'm going to leave myself a note for this because I want to make a video on refi current. And this would have been an amazing question. Did we ask this last week, Jason, to our underwriter? To investment. I can't imagine a scenario where they tell you to move out. More likely, you're doing it as a investment property, and then you get questions while you're in process of like, you're living here. Why is it you doing it as an investment? You provide a letter of explanation saying, I'm going to find a place to move into in the next 3 months. This is going to be an investment property. That's why I'm doing that. They go, okay, cool. Because you're trying to do it the right way. Are you sure it's on point, Marco? I mean, yeah, it's all right. $10 haircuts, expert haircuts in Sacramento on Folsom Boulevard. $10 all day. Lindsay Morgan, congrats. Just opened escrow in San Bernardino. You can find a house in San Bernardino for $500,000 or $600,000, right? I feel like some of my LA County, Orange County folks go to San Bernardino and it's a little bit more affordable over there. I'm just curious. You don't have to answer that, but congrats on getting into escrow. Carrie, thanks for joining. I know about as much about 1031 as I need to know to then get folks to the proper professionals and say, here's a person who specializes in 1031, just kind of like the tax stuff where I know enough to be dangerous. And I say, please talk to a CPA. So I wouldn't want to give you bad information on a partial 1031. I know that I've sat in some great 1031 classes where they talk about the boot and, if you do a partial or the full 1031 and how that all works, tax wise. I've long forgotten it, to be completely honest. So I wouldn't be the one to speak to on that. Drive NYC, thanks for joining. No dumb questions here. Your dumb question is something that many other people are wondering. So by default, it's not dumb. And this is actually a great question, considering the fact that we're in a raising rate environment. As rates continue to increase and people are sitting on 2.75, 2.875, 2.99 interest rates, there's going to be more and more of these conversations being had. Hey, Matt, if I do cash out, it's 3.25. I'm currently at 2.875. Does that make sense? The truth of the matter is it depends. If you've got a 2.875 and you owe 400,000 and you're telling me I've got 11,000 in credit card debt I want to pay off, I'm going to do a cash out for 15,000, pay off that debt, and now I'm going to have a 3.25. I would tell you never do that, right? Pay an extra 3/8 from 2.875 to 3.25 on all that 400,000 makes no sense at all. Don't ever do that. Never, ever, 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 ever. But, you can find scenarios where you owe 400,000, you're at 2.875, you've got $86,000 in high, like 16, 18, 20% credit card debt. And we can go to 3.125, pay a half a point maybe for that 3.125 on a cash out refinance. That probably makes sense for your overall financial picture, right? Pay off all that debt, credit goes up, you've got probably $1,500, $1,800 in monthly payments that are going to be wiped away because of paying all that debt off. Apply that towards the new mortgage. One, you're going to pay much less interest because you're going to jam that money that you pay on credit cards into the new mortgage. So there's that. And then, as it relates to home equity line of credit, in that case where there's only 11,000 in debt, go get a home equity line and pay that off with that, or create a plan to pay off that 11,000, but don't refinance your whole mortgage and pay a higher interest rate on everything for a small amount that needs to be paid off. Hopefully that made some sense. Zeta, do I think that 2022 will be a better year for home buying than 2021 or the same? I mean, better year is probably subjective. A little bit easier for buyers? I hope so. Cheaper prices? I don't think so. Loan terms as good as 2021? I don't think so. And some people, I've talked to thousands of consumers. Some people in the peak frenzy state that we were in early 2021, where there was 26 offers, it seemed like, on every other house. I think those days are gone. And for some people, even if it means a higher price, if they're going against less competition, that feels like a better market for them. Let me say that again. I've talked to people that said, I'd rather buy at 520, only having to compete against 2 offers, than buy at 500, having to compete against 18 offers. It just is more stressful. It feels like a higher anxiety type deal when it's listed at 449. Your offer, counter offer, multi-counters, 17 people in the runnings, and you're bidding that up to 505. Some people are like, I'd rather wait, even if I pay 520 down the road, to where I just find a house I like it, 520, good, right? So that's kind of a, depending on your stance, your view on what a better market is. Seize the day. What's the best loan option for a real estate investor who's a self-employed W-2 worker earning $150K with personal assets over $2 million? W-2 is generally through an employer. So if you're self-employed, you're like Schedule C or S Corp. Self-employed and W-2 are opposite things. I'll edit. You haven't reached 2 years of self-employment. You're 1 year in. So maybe you're W-2 in the past. Now you're self-employed. 1 year into that. Your best bet is the type of loan that I was talking to a client about today, where if it's for an investment property, there's a debt service coverage ratio loan. You've got a payment of $2,000. You've got a house that rents for $2,000. You put 20% down. There's not much more to that loan besides that debt service coverage ratio, which just means the payment versus the rent is at least 1% or greater. Or you're self-employed for the last 12 months. You've got $17,000 a month or $14,000 a month going into that bank account. We can use those deposits. Most of these lenders will use a 50% expense ratio, meaning $14,000 a month in deposits equals $7,000 a month in income, because we're using 50% of that as an expense ratio. You put 20% down, you pay a higher interest rate, but it's a loan that's available, right? So that's probably what you'd be looking at until you get to the point where you've got 2 years of self-employment that have hit your tax return. And in that case, we're looking at bottom line. Remember that. You might have a top line of $550,000 in gross, but the net, whatever hits the bottom line net on your tax return, is what we have to use for lending purposes. Alvaro, perfect question. Let's see if you asked it yet. Nope, I just scrolled the bottom. It hasn't been asked yet. So go ahead, shoot. Let me know. The transparency for someone who isn't used to the process is empowering. Thank you for your content. Take time to make it. That's exactly why I do. Because I know, here's a funny story. I had a claim on my homeowner's insurance because we had a storm where my roof collapsed. And people that know me know this story because I posted a picture of my roof collapsing on Facebook. Long story short, They had one team of professionals that came in and did all the restoration, or whatever they call it, where they make sure there's no moisture in the walls. The moisture that was in the walls, they have to tear out the drywall. They got to put those big machines in that basically suck the moisture out of the air, make sure it's safe. Do mold testing, it's got to pass that. Then they send in the person from the insurance company to basically bid on, okay, what's it going to cost to rebuild all this stuff? So anyway, the guy comes in, super nice guy from Farmers Insurance, does that whole bid process, or quote process, says here's what it's going to be. You can use this company, you can use your own company. Sent me these 14 pages of things. I had so many questions, and some of the questions I realized after I asked him and he responded, I go, I'm sorry, man, I'm just not familiar with this stuff. It's, I can read mortgage disclosures in my sleep, and I know what it all means, and I'm comfortable with it. But looking at, these different line items on an insurance settlement, or whatever the heck you want to call it, I was just foreign to it. I was like, does this include labor and materials? Is it just materials? When he had answered a few questions to him, and then I got him on the phone. I said, listen, man, I understand that some of these questions, after I ask them and you respond, I realize how silly they look, but realize I don't know anything. And so I'm going to have questions like this. And I related it to mortgage in that people have all these questions for me. I'm self-aware enough to understand the average person who does 1, 2, 3 mortgages over the course of decades. 1, you're not going to know this stuff. 2, I don't expect you to. You're a great nurse. You're a great firefighter. You're a great customer service rep. You're a great whatever the heck you're doing in your profession. And there's no need to be a mortgage professional. You just need somebody who's willing to say, okay, sure. Yeah, that page is a little bit confusing to look at. Here's exactly what it means. And so this is me and my team's passion, right? Is putting out as much as we can as far as consumer education so that you're empowered, like you said. So thanks for acknowledging that. I appreciate it. There's going to be more of it. We're doubling down, tripling down, quadrupling down. Me and my team, are constantly trying to improve the mortgage process. We're finding little areas where if we get the same question more than a couple times, it means we've got to do something education-wise sooner in the process, to where ideally people go through and they go, this is what expectation was set. This is the education that was there. And here's what's coming now. And it's, it becomes a lot better client experience for the consumer when they're not just like signing and like, I don't know what this means. I think Matt's and his team, are doing a good job for me. I don't really know. Hopefully this is cool. Like that's not what you want to do. As a consumer, I know for me, it's the same thing when I'm, buying a car or getting that insurance settlement estimate, right? Like I want to at least have a general idea of what the heck I'm looking at. All right, Theo B. When doing a cash out refi, when the lender asks what you think your home is worth, where are you supposed to get an accurate estimate? This is something that the lender's going to ask you. Because we can just pop onto Zillow or Redfin or Realtor.com. I've got lenders that provide like House Canary and other really accurate estimates. But a lot of times I'll ask folks this because people generally like to know what their house is worth. So you might know, oh, my neighbor's house sold for $560. Mine's a little bit nicer. Mine probably would appraise for $575. Or you might say, oh, 3 doors down, this place just sold for $800. It's been remodeled. It's a little bit bigger lot. Mine's got to be worth at least $750. Whatever that like internal kind of what your house is worth might be a better finger on the pulse than some some of these online algorithms, right? So that's all. Marco, I appreciate you. Thank you. I really can't tell folks enough. And I guess since it's Thanksgiving week and we're giving thanks and gratitude and all that other stuff, if you knew how much joy it brings me to hear people say, I've been watching you for years. This has been super helpful. Any of that stuff, like it's one of the most gratifying things I do. Obviously, we get to the finish line with the first-time home buyer that never thought they could buy a house. Extremely gratifying. We close a refinance where they've been turned down at another lender. Extremely gratifying. Tons of stuff in my job is gratifying. This stuff where we're able to make an impact and help folks, even the folks that don't work with us, right? It's like at scale, providing mortgage education so that consumers are, educated and empowered and whatnot is cool. Super freaking cool. That's all I can say about it. So I appreciate you. I appreciate the fact that you've been watching a while, and more of those calls I'm getting, right? Where it's like, I've been watching your videos since high school, for 3 years. I'm going to keep making them. Keep watching them, please. All right. A part-time income question. I didn't read the whole thing yet, Maria, but I appreciate the question because a lot of folks are in the same boat as you, working part-time. How is part-time additional income factored in if you work for a company for 4 years and in year 2 things slowed down and picked up greatly? Year 3 and 4 has stayed steady. Anything that's part-time is going to be a 2-year average. The only thing that might hurt you is when you're talking about this 4-year period and 2 was slow, 3 was great, and 4 is steady. If those 3 years are 19, 20, and 21, lenders look at a 2-year average, but the last 2 full years are your years 2 and 3, 19 and 20. And so what a lender's going to do for you specifically is say, okay, 19 was, let's call it 24,000. And then they picked up greatly, right? So year 3 was 48,000, and you're probably going to do another 48,000 in year 4. Since we don't have 2 full years, 20 and 21, they're going to look at 19, 20, and the first 10 months of 21. So we're going to have to take a 34-month average. I'll do it. And since we're not fully through year 4, through 10 months, you made 40. So we'll call it 40, 48, and 24. 40 plus 48 plus 24. Then we'll divide it by 34 months. 3.29. So you're not going to get $4,000 a month that you're currently receiving right now, because we got to average out all those 34 months. It's going to be like $3,300 a month. Come January, where you've got a W-2 for 2021 and 2020, right? 20 and 21. Now you've got 2 years where you're making $4,000 a month. That's going to immediately up that. So if that's similar to what you're looking at for your specific job, know that right now's pre-approval isn't going to be as much for, it will be once we click into 2022 and you've got the last 2 years W-2s to show that increase. Dynamic performance development. Can you explain how the prepaids work for the following year? If you close in December of 21 with 3% down, you still have to pay them for the following year. Okay. I think I can answer this because it seems like in your head, you're like, oh, I'm prepaying for next year, 2022. It's not exactly how it works, because you got to realize whenever you close, whether it's July or August or December, that 1 year of homeowners insurance is going to be a 1-year policy from when you close until the next year. So that 12 months is 12 months, whether it's December, January, July, or August. And then also for property taxes, Depending on what county you're in, you might have an April bill and an October bill. Depending on where you fall, you're going to pay a certain number of reserves, or a 6-month bill and then a couple months of reserves, depending on when that's due next. But you're not going to pay more or less for the whole year based on what month you close in. Let me try to give an example that might make it more clear, because I feel like I'm confusing myself. We're closing in December. The last property tax bill already was paid. We might collect 4 months of reserves. And so let's say property taxes are $3,600 a year, $300 a month. We're going to collect, we'll call it 5 months of reserves. We collect $1,500 in the account. You close in December, your first payment's due February 1st. You make February's payment, February's payment, March's payment. And so another month goes in, another month goes in. Now you got $1,800 and then $2,100. April, another property tax bill is due for half the year, $1,800. That $1,800 comes out. Another $300 in April, another $300 in May, another $300 in June. You'll have another, $2,000 or so in there when it comes due again next October, and they pay that $1,800 to the county for your tax bill. Hopefully that made sense. If it didn't, I've got a video on escrows. I probably explain it better in the video. So yeah, that's my attempt so far. Sorry if that wasn't clear. You are very welcome for taking the question. Paneshi, thank you for entrusting us. We appreciate the heck out of it. I know that my team strives to do a great job. So let us know, if at any time you've got anything for us. Just because we close the loan doesn't mean we're done, right? You're going to have questions for years to come. You're going to get a ton of stuff in your mailbox. Closed a home loan, and so people are going to be soliciting you with a bunch of junk mailers. Take a screenshot, send us an email. What does this mean? What is this? Why are they sending this to me? Whatever mortgage-related real estate questions come up in the future, we're happy to help. Thanks again for entrusting us with your biz. Appreciate you. All right, Jason. People love to talk about housing crash, so why don't we talk about it, right? I see very, 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 very little evidence, little chance that we're going to see a housing crash. Like such a minute chance. There's so many things pointing to home price appreciation, and like so few that like we would even see a 5 to 10% decrease in home prices. But here's something to think about. Could that put many who's cashing out underwater? Anybody who's doing a cash out refinance is maxed at 80% loan to value. So if you've got a $500,000 house, no lender, none of them no lender is going to do a loan above a $400,000 loan. So you've got $100,000 of equity that the lender is forcing you to keep in the home. In some crazy wackadoo world where some of these YouTube conspiracy theory folks think that we can see some sort of correction, the housing market would have to go crazy correction to put these folks underwater, right? Let's say that in the next 6 months, prices go up by 5%. Now they're at $525,000. Now their $400,000 loan they owe $397,000 on. Like it's got to go down by 25%. And they're not even really underwater yet, right? Like it could go down 40%, and now they're underwater. 25, 30%. They're kind of just like, what it's worth. But here's the thing. In 2008, 9, 10, 11, when somebody's home value went from 500 to 250 and we saw a humongous 40, 50% correction over a few years, the problem was that now that they owed 400, I mean, they would let them leverage it all the way to 100% loan to value. So maybe they owed 500 and now it's worth 3. They were also in variable rate loans that continued to change. You know, the rate would adjust and payment would go from $1,700 to $2,300 to $2,700. And people were like, no friggin' way I'm staying this loan. If you're in a house today where your payment is on a 30-year fixed, and newsflash, that's like every single loan that exists almost, and you're paying $2,300 a month, you've got a stable job, you know, you had to qualify for these loans. There was pretty strict requirements. So you've got like a state job, you've got a stable W-2 job, and you've got a fixed payment that you can afford. For home prices to correct so much that you're underwater and in trouble just seems like a near impossibility to me. I don't know. My 2 cents. All right, Alvaro. Converted my primary into a rental in 2017. I just finished my refi this year, but would like to move back in May 2022. Would I have to refi to primary again to get the best rate on a HELOC, or should I just cash out instead? If it's your primary and you show the bank that you're applying for the HELOC that it's your primary, I don't think they're going to contact your first lender and be like, hey, is this an investment property? Is this a primary? But if you're truly moving back into it, I wonder if you might want to look at like a cash out refinance as an owner occupied, because you're going to get better terms there. I mean, the thing about a HELOC is if it's an investment property, very few banks will do a home equity line of credit on an investment property. You're almost always going to have to be living there to get a home equity line. So hopefully that answered it. C, not annually, not quarterly, biannually, twice a year. Dynamic performance development. The best way is if you're like on a specific YouTube channel, you can search. I think if you're like on my YouTube, you can search Matt, the mortgage guy. I'm doing it the old fashioned way. I typed in Matt, the mortgage guy escrow, and the first video that comes up is how do mortgage escrow accounts work. I'll post the link to it. But the cool part about having 500 videos on YouTube is if you type in Matt, the mortgage guy, and a term, if I've made a video on it, it should come up. Man, this is funny. This is a funny change to YouTube, is it doesn't tell me how many dislikes it has. It's got 384 likes and like 14,000 views. So it's a video people like, apparently. I don't know how many people dislike it. All right, copy. And I'm going to post it in the chat. But don't leave. Watch this later. Open a separate window, copy and paste this link, press pause. Go to this video afterwards, right? We don't want people leaving the live stream because this is too much fun. Oh, only 4 dislikes. That's pretty good. Yeah, I think this video, besides having to look at the back of my head for part of it, I did a pretty good job on it. So hopefully that one helps you with understanding escrows. How do sellers know what you're using, what offer you're using during your offer? Do you mean like what type of loan you're using? Conventional or FHA or something like that? That's disclosed in your offer. That's my best guess at what you're trying to ask here is like, how do they know what type of loan you're using? You know, you're gonna write that into your offer, the type of financing, how much down you're putting, what you're offering price wise, and contingency periods, all that stuff's gonna go into your offer. There you go, Rob. Twice a year. In almost every state and county that I've seen, it's twice a year. All right, Jessica, thanks for joining. Appreciate you. We're doing a cash out refinance on our investment property. I want to use the money to fix our primary, turn it into a rental. We're considering also buying another primary. We would then own 3 rentals and a primary. So far, so good. Not sure if it would work out or not. Need to research to see if it's doable. Or maybe we would rent ourselves and just have the 3 rentals for a bit. Well, you know, if I were you, there's no amount of research that you need to do. It's just a matter of getting with a qualified lender and saying, here's my plan. What do you need from me? I get this all the time too, where I get on a phone call and we can say, okay, this rental at, $1,425 a month is your mortgage payment. And this rental is $1,608 a month. Your current primary is $2,326 a month. You're looking to buy this, you're looking to put this much down. More often than not, 98% of the time, great conversation. Only logical step is let's get an application, let's review it, and we'll tell you exactly what you're eligible to buy. Because we've got to look at tax returns and how much rent shows up on the tax returns. We've got to look at income. We've got to look at the credit report. We've got to take it all into account to say, what does your debt ratio look like buying the next one? The good news is a good lender is going to be able to tell you exactly that stuff. And it really doesn't do you any good to talk general numbers or try to do any calculations on your own. Because inevitably, there's folks that come to me and they're like, I don't know if it works. And then we drew the numbers. We're like, yeah, you're good. You can buy something for $450 with 25% down. Or there's folks that, really think that they could buy and they start looking at rental properties only to find out, yeah, the last 2 years on your tax return, you've shown huge losses on your rentals. Not even close. So just get with a professional, let them review it. They'll guide you in the right direction. Because if there's a loan to be done, if you qualify, they want to help. And if not, good lenders want to tell you, like, listen, don't go out and get the contract. This could be costly for you if you go out there and put in a deposit or something somewhere. All right. Oh, Theo, man, this is the cool part about having return clients, return folks on here. Like you know me better than I know myself. You know what goes on. We're just providing straightforward information. All right. Did you provide it with all of it? 290K loan, 760 score. What's that? 20% down. It's like a 370 purchase price. Making me do math this late, man. I've been at work for 12 hours. Yeah, we'll call it 370. It's a 296 loan amount, but it's pretty close. I got a guess for you because I've been pricing a lot of investment property stuff. Purchase, 20% down investment property. I'll tell you what, offhand, 20% down is gonna stink, man. Lenders do not like 20% down right now on investment property. They like themselves some 25% down, I'll tell you that much. But you're going to have to pay like 1.5 points for a 3.875 with 20% down. And then watch what happens when I put 25% down. 1.5 points for a 3.875 with 20% down. And let's see what it looks like with 25% down. That same 3.875 with 0 points. So that's the difference, is about 1.5 points in cost for the same rate. And obviously, like, you can buy it down. You can go, you can pay 1 point to get down to 3.5 if you so choose, if that's what you'd like to do as an investor. And it's a long-term hold. You're going to stay there forever and ever and ever. All right. Year of the dogs. Sellers know what offer you're using during your offer. And the follow-up is know your lender, I mean. Do they know what offer you're using? I am following. Oh, do they know who your lender is? They should. In most markets that are super competitive, you're going to submit an offer. You're going to provide a pre-approval letter. And if you've got a good lender, the lender is going to tell your agent, let me follow up. Because here's what's going to happen. You submit an offer without a pre-approval letter or a pre-approval letter from Quicken. A realtor submits another offer for somebody else with a pre-approval letter from Matt the mortgage guy. Pre-approval letter attached, me CC'd. I follow up with the agent. I say, hey, listen, we close hundreds of deals per year. I've got a well-qualified client, DU approval, money in the bank. That's verified. We can get this thing closed in 21 days. Walk in the park. Let me know if you have any questions. Call me directly. That selling agent gets off the phone and goes, I feel good about that deal. That deal is going to close. I'm going to go tell my seller, these offers are really close. Year of the dogs might have netted you $1,000 more, but I talked to the lender on this other deal. It's a lender that I feel really good about is going to get to the finish line. Year of the dogs is using some rocket ship out in, some other state. I don't know if that thing's going to crash and burn. I don't know if it's going to get to the finish line. Let's take the offer where the lender actually is a human being that runs a high quality team and gets things to the finish line. That's just my 2 cents. Oh, this is pure gold. I'm gonna text this to Zuber right now. They're jealous, right? They're jealous of the hair. There we go. I'm taking a picture to send to those guys. All good dudes. Dion, Matt the lumberjack landlord, and Zoobs are all good folks. All right. Oh, you know what? No, I'll go back to that one. I think I missed one. I try to get to all the questions, I promise. I do my best. Can we put down only 5% to buy a four-plex? Or do I need to keep saving until I have 20%? A lender I talked to said I need to put down a minimum of 15. 756 credit, wife is 630. Josh Martin, here's what you got to do. You've got to figure out if it's owner occupied, you can put down 3.5% with an FHA loan. If it's owner occupied and you qualify for home ready, those are going to be 5% down. It's a weird little caveat where you got to qualify for home ready. So I wouldn't necessarily count on that conventional wise. But if a lender told you 15%, they're probably referring to an owner occupied deal, right? Where you're going to live in one of the units, which is fine. With your wife's credit score being 630, it's going to probably be hard to qualify for conventional. You probably have to go FHA. But for a fourplex, it's not that bad because you're able to put down 3.5%. And not spend a bunch of upfront capital. So I would check that out. See, Theo? Making me all do all this work. I'll tell you what, it's going to be close to what I talked about before, but worse. And people are like, why worse? These lower loan amounts. Well, maybe it's 232. It's not too low. But once you start getting like sub 200, sub 150, sub 125, rates get worse because lenders aren't really feeling it. Yeah, this is going to be similar to what I talked about before. Point and a half for 3.875, and next to nothing for 3.875, or pay that same point and a half and get like 3.375 with 25% down. Do 25% down, dude. 14,500 on that purchase. That the extra 5%. Well worth it. All right, here's a popular question. Can I do 3.5 to 10% down on a primary and turn second into rental? What do you mean by second? Turn your first property into a rental, like the last one you bought? Turn this one into a rental down the line? Those are possibilities. The difference between 5%, 10%, and 20% down is not big at all. Literally, like, you can just call it the same interest rate. You're just going to pay mortgage insurance when you do less than 20% down. That's the real only significant difference. Tim Jacobs, 6.125? Did you fall asleep in 2007 and just woke up? Rates are low. If you've got enough income on paper to qualify for conventional loans, you are going to be very happy with what you can get. You can go to the low threes. Let's call it 3 1/8. Go from 6 1/8 to 3 1/8 is probably, depending on loan amount, depending on home value, what the loan to value is and whatnot. You're going to lower that significantly. Well, if you owe $400,000, 3% is a big deal. It's like $12,000 a year in interest. If you owe $57,000, it's not as life-changing of a savings. I saw a funny meme on this recently. What are current 30-year fixed rates? Primary or investment? 780 credit score or 620 credit score? Single family, condo, duplex, quadplex, 70% loan to value, 40% loan to value, 80% loan to value. There's so many variables here that I'll just tell you somewhere between 2 and 4%. For the average, and that's the smart ass reply, right? The honest reply, which is what I should have started with because I'm a nice guy. I'm not, trying to be a smart aleck. Let's say you're putting 5% down and you've got good credit and you don't want to pay a bunch of points up front. Somewhere in the 3% range is what you can expect right now. Rates have gone up maybe 0.3%, where they used to be 2.6. Now they're 3%. If you want to pay points, you can buy it down to 2.75. You can buy it down to 2.5. You can buy it all the way down to 2%. I had a client tell me the other day, I want a 2% loan. And for Theo's example on the investment property, you can buy that one down to 2% too. I'm looking at the rate sheet right now. All you have to do is pay about 9 points. And for the low price of like $19,000, buy it down to a 2%. You would never do that, because you're spending $19,000 to save $200 a month. It's going to take you a long time, like 100 months to break even, but it's available. It's available. Long live Simba. Amen to that, right? That's the Lion King, right? Want to get an MLO job with a depository bank or a sponsor? Any tips on what they look for? I would think that the depository banks, there's not going to be a ton of. I mean, it's a good question. I honestly don't know, but I can guess. They want somebody who's going to work hard and be able to be, coachable, manageable, get in there and learn and grow and whatnot. Wells Fargo, TD Bank, US Bank. Whatever the case, wherever you get picked up, do your best to be a student of the game. Learn as much as you can. I know many people who make that transition from bank to, retail loan officer, broker, whatever it is. Once you have a baseline knowledge and you can go out and source your own business is when you want to leave the banking environment. Because in the banking environment, they'll bring business to you and you'll probably be able to learn. The downside is that you're going to get a very small percentage of the deal. You're going to be selling higher rates and higher fees to folks. But truth be told, there's folks that don't even mind that. I've talked to people where I'm like, oh, I can get you a quarter better and 1,000 less in fees. And they're like, well, I've had my account with Wells Fargo for a long time and I just want to keep all my accounts there. All right, well, long live Simba will help you out, Wells Fargo. That's my best advice. All right, one Sammy. This is another loan officer question, which if you're a loan officer and you're joining these, I appreciate you. We talk plenty of stuff that should be beneficial to you. If you're a newer loan officer, you're trying to figure out what questions people are asking, how you can answer them, what stuff is, things that the consumers, are thinking about today. How do you go about making borrowers trust you and show that the refi process is easy? I think what you do to show them the process is easy is set expectations, walk them down the path mentally. When I talk to folks and I tell them, here's exactly what it's going to look like if you refinance. Provide that Excel spreadsheet that mirrors a loan estimate. And here's what your new monthly payment is. Here's the savings. Here's the true cost. I'm not trying to hide it. It's real. It's going to cost $2,800 in loan costs, like we talked about earlier in the live. You're going to recoup that within 10 months. So if you plan to stay on this house for years, it more than pays for itself to refinance. It's a good idea. And then you tell them, here's how the process works if you want to proceed with us. You fill out the online application, you upload the supporting docs. Once we have everything, we're gonna submit that to my processor. Processor is going to disclose to you. It's going to show the rate. All these things that I showed you on the sheet are going to look the same. You sign those disclosures. That's your intent to proceed. Once all that stuff is signed, we're going to submit it to the lender. If we get an appraisal waiver, there's not going to be any appraisal needed. And when we submit, that's when we're going to know if we get the waiver. If there is an appraisal needed, you're going to get a link to pay for the appraisal. Once you pay for the appraisal, it'll be a couple days before they reach out to schedule that with you. And you can go as far along as you want. I try not to go all the way through the process because it's too much. It's information overload. But if you walk them down the path a little bit, and then they do the online application, they upload the docs, they see it move to processing, they see the loan submitted, they start to see in action what you told them to expect. You set expectations and you met expectations. That's what's going to make people feel comfortable. That's what's going to make people go, oh, that Sammy guy, was really good about explaining things and then really good on delivering on what he said to expect. That's my short answer. Oh, poor UWM stock. As a company, UWM is head and shoulders above the rest. Not even close. Stock wise, they've got like a 5.8% dividend or something. In full transparency, I don't own any more UWMC stock, and that's not because I don't believe in UWM. It's because that money that was in individual stocks was placed elsewhere. That was me and my wife's decision financially. It had nothing to do with UWM or whatnot. We also offloaded Tesla and some other stuffs. So anyhow, yeah, I think it's like below $6 now, right? Like 580. It's a company that I don't worry about. You know, that sector, mortgage, is going to be impacted in the next few years. Refinances might be down 62% next year. When rates go up, not as many people are going to see tangible benefit from refinance. Refinance will drastically decrease, drastically decreasing the volume of a bunch of lenders. UWM happens to be rock stars when it comes to purchase. They're going to be just fine. They're going to grow next year. You know, I'm not a big stock expert, so I probably shouldn't speak on it. All right, Marco's weighing in on Sammy's question, and I'm curious to see what we hate. Just make the phone call or email. Whoever picks up will have to earn your business. I'm talking about personal experience. All right. So Sammy's asking, how do I go about making borrowers feel that the process is easy and they trust you? And Marco's saying he's going to call. And depending on how me or Sammy talk, got to earn my business. Call me, I'll earn it. All right, Theo. It's $14,500 extra down payment. And first, it's going to be an extra $60 a month in cash flow. If you go for that. Actually, you know what? Let me redo the math. Principal and interest for that same cost, right? For that same point and a half. $961 is the principal and interest with 25% down at the 3,375. And then 3,875 got a higher loan amount and a higher rate, same cost, is 1090. $130 a month. So 14.5 and you're paying it down a little bit quicker because the rate's lower. If it's a long-term hold, put 25% down. I mean, you're coming out of pocket 65 grand with closing costs. 65 and 80 are close, numbers wise. It's a lot of money either way, right? Do it. Holy moly, Tim, 6 1/8. If you qualify for a mortgage and you're not like locked in to a refinance by early next week, you're either too rich to care or something. But don't pay 6 1/8 on $325,000. 3 1/8 versus 6 1/8 on $325,000. Rough math, 3% is like $9,000 a year in interest that you're burning. So you're either rich or you haven't taken action for some other reason. Whatever the case, even if you are rich, refinance and give $700 a month to your favorite charity. Because, yeah, about $750 a month is what you're lighting on fire. Oh. Primary, 791 credit score. Oh, is this a rate? It's a rate check? Dynamic. Oh, there you go. I got you. Let's go. Oh, we don't know what the price is. That's always helpful. Shoot a price to me. Just so it's relevant for you. Primary, $791. Purchase. All right. This is a good place to insert this, right? Tim Jacobs, about to save tons of money. Here's what you want to do, Tim. Go to greatmortgagebroker.com. I think they revamped that a little bit. Name, where you're at, what you're looking to do. I promise you it doesn't take more than 30 seconds. I filled out one the other day. I did a test one to make sure people are on it. And we'll get you set up. We'll point you in the right direction no matter where you're at. What state are you in, just out of curiosity? Tim Jacobs. I want to make sure this guy gets to the finish line. Paying 6% plus is tough. I just saw a familiar name, my buddy Brendan McKay. What's up, buddy? Good to see you. It's a top-notch mortgage broker, Brendan McKay, right here. Doing good things, helping consumers. I appreciate you. All right, Jason Hibbert. I know I had skimmed briefly by the fact that if you qualify for Home Ready, you're able to put down 5%. Home Ready is a mortgage program. First-time home buyers, 3% down, 5% down, discounted rate, discounted mortgage insurance. But in your case, where you're talking about buying a four-plex, if you qualify for Home Ready, which you've got to be at 80% of the area median income. Different parts of the country, it's going to be different. Near me, I think the area median income might be, we'll call it $80,000. So to be under 80% of that, you got to make $64,000 or less per year. That's why it makes it extremely difficult in California for people to qualify for this, especially if you're going and trying to buy an $800,000 fourplex. But if you qualify under their parameters, and if you just Google Home Ready, I probably have a video on it. But if you Google it to look at qualifying parameters, or talk to a local mortgage broker who could help you out, that's probably your best bet. And then you can see if you qualify. I literally made a video on this 5% down Home Ready. I couldn't find anybody talking about it, but I promise you that it's out there, where it's changing from 15% down, 85% LTV, to 5% down, which is 95% LTV on 2 to 4 units, Home Ready, Home Possible. I thought I was going out of my mind because I saw this guideline somewhere and then nobody was talking about it. But maybe I'm just ahead of the curve, right? Long live Simba. Look at all these aspiring loan officers. I'm telling you, one, it's the greatest thing in the world. And two, some of these folks that have been in the mortgage industry for 30 years and that are, 60 years old, they want to retire. They want to pass the torch. So if you've got sales experience, but no mortgage experience, you'll be fine. The lenders who are winning today are doing whatever they can to provide value, education to the consumer, to the real estate agent partners, to anybody who will listen. And then it becomes a lot less about sales and more about, people like and trust you, come to you for first advice, and then second, the mortgage, right? Because as you can imagine, as a brand new loan officer, the hardest thing is you're getting somebody to entrust you with the largest purchase of their life, or if it's a refinance, the largest financial transaction of their life, $400,000 in borrowed money. So getting licensed, putting a Facebook post out is not going to do the trick. You've got to provide enough value, do enough so that people like and trust you. I can tell you from experience, I was doing a lot of stuff in 2014, 2015, 2016 that just now is bearing fruit. But knowing that, providing advice to people that were not doing business with me at the time, doing live lunch and learns, doing YouTube videos, doing things like that, were going to, be a long-term play that would be helpful, because any business you're in, whether it's mortgage or whether it's, selling steak knives, the more value you provide, the better your business does. The end. Thanks. That's my TED Talk. Yeah, we'll have to find out how many years my buddy Tim has paid into the loan, because, if it's 6 1/8 and he's been paying on that for 8 years, you go to 3 1/8 and a 20-year loan. 1, you're going to shave 2 years off the loan, and 2, your payment's going to drop dramatically. So no matter how many years you've been in, there is benefit, right, to doing a refinance, shortening the term, or, keeping the remaining term in place. I've got, flex term, where if you're in it for 11 years and you want to go to a 19-year, let's go to a 19-year. But paying 6 1/8 on the loan is something that I don't recommend to anybody. You know what I'm going to do for you, Tim? Because in New York, it's hard to get licensed. So it's going to be a while before we get our folks licensed there. I'm going to give you the best in the business. And you tell them the Matt the Mortgage Guy sent you. B Lavender at MadisonMortgage.com. Shoot this guy a message. B Lavender at MadisonMortgage.com. Yep, you got it right. The British mortgage broker. He's got it. He's a great dude. We shared a stage in Irvine, California in 2020. He'll take great care of you. So hit him up. If you can skip the greatmortgagebroker.com, honestly, because my team is likely just going to connect you with Ben or some other broker in New York. That's the one to connect with. Here you go, Tim. I don't think Ben minds. I'm sending referrals, giving his number out, but do that one right there. Write that one down real quick for Ben Lavender. Tell him Matt the Mortgage Guy sent you. He'll take great care of you. You'll pay less interest to the banks, and you'll be in good shape. I want to end it, but I don't want to miss anybody's questions. I think I started to price this one for somebody. Dynamic performance. I never got the loan amount, but we'll say 5% down. And I just priced like a $400,000 loan amount with that 791s. You're probably at about a 3 1/4 interest rate. Rates continue to get worse and worse. People don't believe that rates are going up, but one of these days they're going to believe it because they keep going up. 3 1/4, and you're going to pay about $63 a month in mortgage insurance at that, $380,000 loan amount on a $400,000 purchase. So that's a good kind of idea on where rates are at and what you should expect to pay there. Different mortgage insurance based on, what lender you use. And so, I hate to bash certain types of lenders and stuff, right? But it's like, talk to a local mortgage broker. They're going to get you a great deal. They're going to be working with lenders that have, the cheapest mortgage insurance. Where is, oh, here we go. I was trying to price 3% down. In general, you're going to get cheaper mortgage insurance and a lower rate, putting 5% versus 3%. So if you have the option, there to put 5% instead of 3%, I definitely recommend you do that. I was just pricing it to kind of get a feel for what the difference was. Conforming, conventional, monthly mortgage insurance. Yeah, your mortgage insurance goes from 63 to 106 if you go 5% to 3%. And, the rate is closer to 3.375 than it is to 3.25. So an eighth higher in rate, $43 more in mortgage insurance. If you got 5%, do it. That's my time for tonight. Thank you so much to everyone that joined. Happy Thanksgiving to everybody. I'm grateful to have at least, 30, 40 people a week that find me interesting enough to join here and ask questions and whatnot. So keep coming back. Let me know, as always, who I can bring on to make it as interesting as possible for you folks that are tuning in. Last week, I got a lot of good response from having an underwriter on here. I know we've had appraiser. We've had real estate agents. Do you want to see more real estate agents? Do you want to talk to real estate agents about what they're seeing, what they're feeling? Maybe I'll get my buddy Mark McDonough to come on next week. It's long overdue to do something with him. So, yeah, let me know who you want to see, what you want to talk about. If there's anything I can make a video on, it feels like, there's endless content, different things I'm reading every day. I probably have a list of 5 or 6 videos I want to make all around educating the consumer so you can be empowered, informed, make better decisions about your mortgage, about your finances. Until next time, thanks again, and we gonna see.